What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. I actually had a request for this video to break down the different types of life insurance policies that are available, especially when it comes to using life insurance to build and protect wealth, using the infinite banking concept, just things like that. And just do a comparison of them, just break down how they work, what the risks are, and just what you need to be aware of so that you can make the best decision for you. So we're going to talk about universal life, variable universal life, index universal life, and then whole life insurance as well, which in my opinion is the only true permanent life insurance policy that is available. These other universal life products that are promoted as being permanent, and I put that in air quotes for a reason, is because they do have the potential to lapse due to rising cost of insurance. We're going to get into why, but if a life insurance policy has the ability to lapse due to cost of insurance, is it really permanent? Not in my opinion. I don't think so. And I think it's really misleading. A lot of people, unfortunately, buy some of these products thinking that it's always going to be there as long as they make their premium payments. And that's not always the case. You can run into a lot of problems with these different types of permanent life insurance policies. And that's why I want to do this video. And I'll link down below, too, to another video I just did breaking down, unfortunately, a true story. It was an article that a friend of mine sent me, and it was about a lady that a 72-year-old lady that had purchased a universal life policy, this permanent policy that she thought was always going to be there as long as she made her premium payments, and she got a letter in the mail saying, hey, you need to pay even more in order to stop this policy from lapsing, meaning she would no longer have the coverage. Like all the premium payments that she made would be for nothing. So when your policy lapses, it's canceling the policy. You no longer have the coverage, even though you paid into it the entire time. And it's a really sad story. Make sure you check that video out because I go into a lot of detail about how that type of policy works. But in this video, let me actually go ahead and share my screen with you guys. I want to break down. First, we're going to start with the air quote permanent life insurance policies, and then we're going to talk about whole life. And here's the thing: I'm a huge fan of dividend-paying whole life insurance. I'm just going to come out and say it. I am biased, but it's because I use it in my own life and I know how amazing it is. Now, does that mean it's right for you? Of course not. But you can't make that decision until you understand how these things work. Because otherwise, how do you know you're making the best decision for yourself? If you don't know how they work, you don't know what all your options are, right? And so that's why I want to do this video, and so that you have clarification on the different types of life insurance policies that are available, so you can choose what's best for you, what makes sense. All right, so 3 types of permanent insurance built with term, and the reason I say built with term is these 3 products right here, okay? These are promoted as permanent life insurance policies, even though they're built on what's called annual renewable term. That's probably one of the most important things you need to understand when we're comparing different types of permanent life insurance policies. Because annual renewable term, what that means is basically if you were to think about getting a term policy for 10 years, for example, okay? What happens at the end of that 10 years? Well, it expires, right? So you were covered during the 10 years. You made your premium payments. You had really cost-effective coverage, but then it expires at the end of 10 years. Okay, so annual renewable term is basically a 1-year term policy that just keeps renewing every single year. What that means, though, is so what would happen if at the end of the 10-year term policy you wanted to renew it? It would be a lot more expensive because you're 10 years older, right? Makes sense. That's how term insurance works. So one of the big issues that can cause a lot of problems in these policies here is the fact that the annual renewable term, because it's renewing that term insurance every single year and you're getting older every single year, that means the possibility of you passing away is increasing, right? So what you would pay for a term policy at 35 is a lot different than what you'll pay for it at 70, as far as the cost of insurance goes. It just makes sense. So these 3 policies here, okay, universal life, variable universal life, and index universal life, they're all built on annual renewable term. That means that your cost of insurance for these policies is going to get more and more expensive every single year. Now, there's ways to mitigate that issue. That is not necessarily a deal breaker for these policies. I'm not saying not to do these policies because of that, even though I would never buy any of these, but that's a separate issue. We'll get to that later. But you just need to be aware of it. because I think the biggest issue that exists when it comes to trying to figure out which type of permanent life insurance policy makes sense for you is people don't understand how they actually work. So you need to know that your cost of insurance is going to go up every single year, regardless of which one of these policies you go with. Okay. And again, we're going to talk about whole life after this, but it's really important to set the foundation on how these permanent policies work. Okay. So what are the differences between these three policies? Well, really the main difference is how the cash value grows. And I guess that's why these get lumped into the permanent life insurance category, is because they have that cash value component, or at least that's part of it. Basically, cash value. So what is that? Think of cash value as the equity in your home. All right. So what can you do with your equity? What does it mean when you have equity in a property? Okay, so you can borrow against that equity in the form of a home equity line of credit, right? And also that it represents what you would get if you sold the house today, right? That's basically what cash value is inside of a life insurance policy. Okay, it represents how much you can borrow against if you want to, and there's lots of different strategies for using the cash value in these permanent life insurance policies. It's what makes them so attractive is that cash value growth, because of the tax advantages that life insurance has, where the cash value grows tax deferred and you can access it tax free in the form of policy loans. You can do withdrawals as well, but people don't usually do that. It's a great feature of permanent life insurance, is the ability to borrow against that cash value. The same way you can do that in a home equity line with a home equity line of credit. Also, the cash value represents what you would receive if you canceled your life insurance policy, or surrendered it is the technical term for it. Okay, so it's literally the same exact type of thing with equity in a home. Okay, so the difference between these three different types of policies here is how that cash value grows. Basically, the crediting strategy that grows the cash value over the long run. Okay, so with universal life, think of the growth in the cash value growth in these policies similar to money market accounts. I guess you could would be comparable, where they're very interest rate sensitive. Okay, so they follow interest rates. Interest rate environment is really, really important for these universal life policies. These are not sold nearly as much as they were before, like back in the 80s when interest rates were really high. These policies illustrated really good, meaning they projected really good cash value growth at 10, 12, sometimes 15% for the entire life of the policy, as if there would never be any interest rate cuts. Well, that's kind of what happened to the lady I was talking about earlier, where when she purchased the policy back in the late 80s, she was illustrated all of this cash value growth. It's going to be here for the rest of your life. And then at 72, because it did not perform as illustrated and her cost of insurance is going up every single year, all of a sudden her policy, the cash value, cannot cover the amount of the cost of insurance that's required to keep the policy in force. That's where you can really run into issues with these policies if they don't perform as illustrated, plus you have your rising cost of insurance, plus you need to manage net amount at risk. We'll talk about that in a minute. Right? There's a lot of things, a lot of moving parts. These are a lot more complicated than what a lot of agents will promote them as. They can be pretty complicated, all right? So universal life is based on the growth of the cash value is very similar to that of a money market account, where it's very interest rate sensitive, all right? So it's going to fluctuate with interest rates, all right? Now, there is guaranteed universal life. That's a separate video. Again, anything with universal life, I'm just not a fan of. But this is where universal life, this was the first one, okay? The next evolution of universal life was variable universal life. And again, it's still built on annual renewable term. So your cost of insurance is going to get more and more expensive every single year as you get older. Now, that doesn't mean that you're necessarily going to get a bill at 72, 75 years old saying that, hey, you have to pay this much to keep it in force. There's this thing called net amount at risk, which is basically calculated as death benefit minus cash value. Okay, whatever that number is, the formula for the cost of insurance in your policy is applied to that number. Okay, it's not applied to your entire death benefit. So if you have $1 million in death benefit, for example, your cost of insurance is not applied to that $1 million in death benefit. It's applied to maybe $100,000 of death benefit because you have $900,000 in cash value and you have $1 million in death benefit. The net amount at risk to the life insurance company is $100,000. So the cost of insurance is applied to that number. I hope that makes sense. It's really important for you to understand that if you are considering any type of universal life product, because that net amount at risk has to be managed. The higher your net amount at the net amount at risk is, the more expensive your policy is going to be. You really need to understand that. Make sure you have a conversation with your agent about that if you are considering this. Now, the crediting strategy, how the cash value grows in a variable universal life policy, is it's based on the stock market. It's invested in mutual funds, indexes. Like you have to have a securities license in order to sell this, which I do not have, because I don't like variable universal life. I don't like any, I'm not a fan of really any universal life products. But this is a good way, to get the tax advantages of a life insurance policy. You have the death benefit, et cetera. You have the flexibility of universal life, plus exposure to the market as well. You're directly invested in the market with these types of policies. So, I mean, if that's your thing, then, a variable universal life could make sense. Again, I'm not a fan of it. I don't think stock market growth should really have anything to do with life insurance, but for the most part, but that's a separate conversation. This might make sense for some people. Okay. Now, with indexed universal life, this is my least favorite right now because it's so popular and it's sold as a very simple product, and it's sold as this. I've heard it called, so IUL, I've heard it called imaginary unicorn life insurance because of how it's illustrated and sold to people as, so basically here's how index universal life works and how it's promoted is you can get upside potential, downside protection in the stock market. So instead of being invested directly in the market like a variable universal life policy, the IUL uses an indexing strategy using call options to get exposure to the upside potential of the market. But because it's using call options instead, if the market goes down, the call options just expire worthless. Therefore, that's how they give you that downside protection. So if the market goes down 15%, you won't lose 15% in your policy like you would maybe a variable universal life policy because you were never actually invested in the market. They used call options instead. Now, there's a cost for that downside protection, and that's in the form of a cap rate. So you have upside potential. Usually cap rates can be anywhere between 9 to 12% right now, sometimes lower. It just depends on the company and the index that you choose, like the S&P 500, for example. All right. So if the market goes up, let's say 20%, and your cap rate is 10%, your policy will only be credited that 10%. Now, that is a gross number. That does not mean your cash value is going to grow by 10% because there are still costs, fees associated with, obviously, with the policy because it's life insurance. But that's how the crediting strategy, the cash value growth strategy works, is they use call options on an index like the S&P 500. You have a cap rate, you have downside protection. That is basically how IUL works. But again, the problem is where things there's a lot of things that can go wrong with IUL, but with an IUL, it's still built on annual renewable term. You have to be aware of that. And it's really important that you manage net amount at risk. I'm not saying that these policies can't perform, that they can't do well over the long run. It's just not very common. It needs to be structured and designed a very specific way. It needs to be managed on an annual basis. The lady I was talking about earlier, she thought that the policy was just permanent. As long as she made her premium payment, she would always have her policy. If she had done an annual if she did an annual review with an in-force illustration for that year, she probably would have noticed that the policy is not performing, that we're kind of running into a problem here, and she could have done something about it. So as long as you're managing your net amount at risk, you're doing an annual review every single year, you can explore these things. Just be careful. Right. One of the ways I describe these types of policies, especially IUL, is if you were to imagine your ideal perfect home, like your dream house at the top of the hill, it's amazing, it looks great. just like an IUL sounds great, right? When I say you get upside potential, downside protection in the market, that sounds really good, right? But when we look at when we go under the surface here, we start digging into how these products actually work. It's just like your dream house at the top of the hill. But if I were to tell you, hey, like, look at this amazing house, but in 10, 20, 30 years, depending on how old you are, let's say 30 years, there's a good chance that the entire house is going to collapse because the foundation sucks. Would you buy the house? Would you take that risk? That's up to you. But that's how these products are. That's how the mechanics of these products work. That's just kind of how they are. They have a really bad foundation built on annual renewable term, and that's why you got to be really careful with these types of policies. Now, that's enough on the permanent. The three types of permanent life insurance that are actually just built on annual renewable terms. So it's very misleading. Let's talk about like the one true permanent life insurance policy that I use in my own life. I'm working on my my second policy right now. I use it to implement, well, for a lot of reasons, but I implement the infinite banking concept in my life. I think it's a really powerful financial strategy. It's done amazing things in my life already. And there's just a lot of benefits to it. You don't have to implement infinite banking. That's, if it's not for you, fine. There's plenty of other things, other benefits that you get with a whole life policy. But if we're comparing whole life to these other universal life policies, the one big difference, I guess, like for this particular conversation, is that the a whole life policy will be there when you need it. And you don't even have to make the premium payments your entire life. Like sometimes people hear whole life and they think they have to pay into it for their entire life. That's not true. There's policies I've seen set up where people only pay into it for 5 years, and then the policy just funds itself. Here's why: because whole life, it has guarantees. Okay, it's guarantees, contractual guarantees. That's what I'm trying to say. Sorry, I couldn't spit it out there. It has contractual guarantees. One of those is guaranteed growth, cash value growth. Right now, it typically ranges between 2 and 0.75%, depending on the company that you go with, which to me is like a really good savings vehicle. That's how I compare whole life to other like financial products. It would be a very good savings account if you could compare it to that. All right. Now, on top of the guaranteed growth of the cash value, you also can get dividends if you set your policy up with a mutually owned life insurance company. Okay. So basically what happens is you become essentially a partner. You own part of the life insurance company when you set these types of policies up. So any profits, any surplus that the company has every year, that gets redistributed to policyholders in the form of a dividend, which is awesome. And many of these companies have never missed a dividend payment in over 100 years, some of them almost 150 years, through the Great Depression, through both world wars, savings and loan crisis, 2008 crisis, pandemic. They all paid a dividend throughout all of that chaos. How many banks failed during those same times? Just something to think about. But anyways, typically a whole life policy is going to get you, it's going to net like 3 to 5% tax-free compound growth for the entire life of the policy. It won't be there won't be a scenario where you're 72 years old, like the lady earlier, where you get a notice in the mail saying you have to pay thousands of dollars now in order to keep the policy in force. That doesn't happen with whole life. Here's why: the costs and fees are level throughout the entire policy. It is not built on annual renewable term. It's permanent whole life insurance. So everything as far as fees and costs is spread out through the entire policy. So when you look at a whole life illustration, what you see is what you get for your fees and costs. Like there's your cost of insurance isn't going to go up every single year to where you have to make a huge payment or whatnot. You don't have to worry about stock market crashes. You don't have to worry about like cap rates and participation rates and all these other things. Like everything is just level throughout the policy. So the biggest difference between these types of policies, whole life will be there your entire life. Any type of universal life product built on annual renewable term might not be there. It's not actually permanent. It's not guaranteed to be there because of all the things that can go wrong with it. All right. Now, when it comes to these whole life policies, like one of the reasons I love them, the dividend paying whole life insurance policies with a mutually owned life insurance company, they are a fantastic asset for building wealth. Imagine having an asset very similar to a savings account that where you're going to net 3 to 5% tax-free compound growth for the life of the policy. It's safe from market crashes. You have obviously the death benefit to take care of your family, make sure they're provided for if something were to happen to you, but you also have access to the money, to your cash value in the form of policy loans so that you can continue building wealth like you normally would. So in my particular example, I'm going to be using my policy to make private money loans on real estate very soon. I'm flipping heavy equipment, and there's a couple of other things that I'm working on. But I'm using my policy to do that because I'm getting the uninterrupted compound growth in my policy while I'm able to build wealth over here. And the only cost to doing that is the simple interest that I pay on my policy loan. I do a whole other video on that, why it absolutely makes sense to do that. I'll put that in the description if you want to check it out. But yeah, that's basically what I'm saying here. You can borrow against your cash value for emergencies, wealth building opportunities, say for market crashes. It also provides living benefits, which the other permanent life insurance policies, the universal life policies, they have living benefits too. But again, if your policy is blowing up, if it's not performing as was shown and illustrated, how much of those living benefits are you really going to enjoy or be able to get access to? And the living benefits is essentially if you were to get sick, if you were diagnosed with a chronic or terminal illness, you could access a large portion of your death benefit, usually tax-free, in order to provide care for yourself, long-term care. If you want to do alternative treatments that maybe your insurance company doesn't provide, things like that, right? It can be a huge, huge saving grace when you need it the most. Right. So it just provides you a lot of options, a lot of financial security when those things happen inevitably, They can also create supplemental tax-free retirement income. That's one of the things that like IUL, for example, is really pushed hard, is all of this amazing, incredible tax-free retirement that you're going to get, which a lot of the times it's just not going to happen. The numbers that people illustrate for IUL is just ridiculous. I had an IUL agent send me an illustration showing me taking out $212,000 in tax-free retirement income starting at 65 for the rest of my life. You want to talk about a red flag. But now that doesn't mean that we can't use these policies for tax-free retirement income. We absolutely can. You have to be careful with it, right? I do a separate video on this, but you can create an additional income stream for yourself in retirement, tax-free, in the form of policy loans against the cash value. So if you've built up the cash value really good in your whole life policy, and it's very efficient, all right? Whole life policies get more and more efficient the longer they're in force, all right? You can borrow against that cash value to create additional income. And the reason it's tax-free is because it's a policy loan. You're not actually taking income. Loans are not treated as actual income, right? Did you have to pay taxes on your mortgage when you purchase your house? No, because it's a loan. It's debt. You pay it back. Same thing with policy loans. That's why they're not taxed. All right. So they can also be a really great volatility buffer as well during retirement, meaning, if the market goes down 20% and you're making withdrawals from your 401k, well, you don't really want to do that when the market's down 20% because you're just making that loss even worse. And it can really impact the ability of your portfolio to provide income for as long as you need it. So when the market goes down, instead of withdrawing from your 401k, you could take policy loans from your insurance policy to supplement that income while you wait for the market to come back, get back to break even, and then you can resume withdrawals. That's kind of the idea of a volatility buffer. And when dealing with sequence of returns risk and things like that, so it can be really powerful for tax-free retirement income. And it's without a doubt, guys, one of the best vehicles, if not the best vehicle for passing on wealth to the next generation. It avoids probate. It gets passed on income tax-free. I mean, we're talking about, again, it depends on how you set your policy up, but the policies that I have, when I'm 80, 90 years old, and, I'm planning on making it to at least 90, but, when I'm 90 years old, assuming that I keep my policies in force, I'm going to have a lot of death benefit that I'm going to be able to pass on to the next generation and, you know, my loved ones, charity, whatever it might be. And it's just an excellent way to build up net worth and pass that on to the next generation. So anyways, that's my spiel, my breakdown of different permanent life insurance policies. And, you know, at the end of the day, guys, I wouldn't even really say one is necessarily better than the other because everybody has different needs. For me, universal life absolutely does not make sense. I want nothing to do with it. I'm 100% dividend paying whole life insurance. But maybe that doesn't make sense for you, and that is okay. You have to do what is best for you and your loved ones, but you can only do that when you understand how these types of products work. So just be careful out there, do your research, work with agents and advisors that know what they're doing, and quite frankly, have their own policies as well and are actually utilizing these things, preferably. But, you know, take your time and just do your research, educate yourself, understand how these things work so you can decide what's best for your specific goals. Okay. So I hope that was helpful, guys. If you have any questions, drop some comments down below. Any other videos that you want me to make, I'm happy to do that. And yeah, we'll go from there. I hope you're doing well, and I'll talk to you in the next one. To your success, Matty Ice is out.